Microsoft, Meta, and Amazon are pouring billions of dollars into servers and chips. The scale of capital flowing into AI infrastructure is staggering. For months, the promise of an AI boom has been the main engine driving Wall Street. A concentrated group of tech giants, known as the Magnificent Seven, has practically parried the wider stock market on its back. But that momentum recently hit a wall. When Google released its latest earnings report detailing its massive AI expenditures, the market didn't cheer. Shares dropped. Investor patience with long-term technological promises is running out. Wall Street is no longer satisfied with abstract visions of the future. The conversation has rapidly shifted to a single, urgent question. How long will it take for these billions of dollars to actually generate measurable, profitable returns? If this tech story fractures because the profits take too long to arrive, it becomes the first falling domino. A loss of faith here risks dragging down the entire market. Investors have stopped trading on potential. They are now scrutinizing the balance sheets, demanding that these historic expenditures translate into immediate, measurable profit. This chart shows a framework economists call the S-curve. We can use it to map the typical timeline of any major technological leap, and it helps explain why these tech giants are suddenly struggling to show returns. It always starts with a vertical surge. This is the hype cycle, fueled by initial excitement, big promises, and a massive influx of capital. Then comes a harsh reality check. The curve flattens out into a slow, highly expensive period. Businesses have the technology, but they have to figure out how to actually integrate it into their daily operations. Once companies figure out the most efficient uses for the tech, the curve bends upward again. This is where sustained productivity and actual profits finally materialize. Right now, we have just hit that plateau. We are trapped right here, trying to figure out the exact forms of AI implementation. The anxiety gripping Wall Street right now is just market impatience colliding with the slow, unavoidable reality of the innovation cycle. Pushing through this middle phase requires stable economic conditions. Instead, tech companies are facing a barrage of external pressures. The Federal Reserve is currently offering almost no forward guidance on interest rates. Markets have completely split on the odds of a rate hike, creating a highly unpredictable environment for borrowing money. Ongoing military conflict in the Middle East raises the constant risk of spiking oil prices, keeping the threat of inflation front and center. Tech companies desperately need cheap capital and steady markets to experiment and build their infrastructure. This global volatility artificially traps them in the messy middle for even longer. Beyond the economy, there is a structural hurdle complicating the path to profitability, a rapidly escalating conflict over model access. Chinese developers are releasing highly capable open-source AI models. These free tools directly challenge the business models of American companies, relying on expensive, closed-source systems. This debate is now spilling out into the open, creating a policy vacuum in Washington. Lawmakers must decide whether government regulations will lean towards supporting open ecosystems or protecting closed ones. For investors, this is the ultimate wildcard. A sudden shift in government policy could instantly wipe out the profit margins of heavily invested tech giants operating closed systems. A return on investment is now tied to international competition and how Washington decides to regulate the industry. The innovation is real, and it will eventually drive major gains across the economy. But getting to that payoff means enduring a highly volatile waiting game.